When your net worth climbs into the multi-million, taxes start being an annual problem. They become a generational one. So in this video, we are going to talk about how the wealthiest family in America, the one with earning over $1 million a year, are locking in their legacy under the new $15 million estate exemption that begins in 2026. So if you are a high earner, a business owner, or someone with investment real estate worth over 10 million, this video is for you. We will break this down into 6 key parts so you will always know where we are and what's coming next. So first, what changed under the new law? 2, some example client story that bring it to life. 3, a step-by-step guide to implement, and then 4, forward-looking planning through 2026 and beyond. And 5, the control without ownership advantage. And 6, final takeaway and next step to lock in your family's wealth. By the end of this video, you will not only understand how the wealthy use family limited partnerships, but you will also know why timing matters and how you can use the same tool to protect your legacy. All right, let's start with what changed. So what changed under the one big beautiful tax bill? Let's clear on the rules of the game. So the one big beautiful bill act that was signed in July 2025 permanently increased the estate and gift tax exemption to $15 million per person, or it means $30 million for a married couple starting in January 1st, 2026. So that's up from $13.99 million in 2025. There is no hard expiration date like before, but remember, permanent is in tax law only means until Congress changes it. So if you are sitting on significant assets, this is the best window of certainty we have had in years to plan transfers without triggering tax. Here's what didn't change, and this is key for advanced planners. You can still apply valuation discounts for lack of control and lack of marketability when transferring partnership or LLC interests. The grantor trust rules remain intact, meaning IDGTs, intentional defective grantor trust, still let you pay the income tax while the trust assets grow outside your estate. And the IRS will honor properly structured family limited partnerships as long as you treat them like real business entities, not personal piggy banks. So with that foundation already laid out for you, let me show you how this plays out in real life. Because theory is one thing, but an example make it click. So let's move on to the next part, part 3. Let's look at Nakamura's estate freeze. So William and Sandra Nakamura from Seattle, Washington, they own a construction company and a handful of rental properties. So total estate value is about $30 million. Now, like many high net worth couples, they didn't want to lose control of their assets, but they did want to protect their kids from future estate taxes. Here's how we structure their plan in 2025, knowing the 2026 law would soon take effect. So step 1, they created a family limited partnership, so FLP, of their real estate and company shares went into that entity. Step 2, they formed a general partnership LLC. So that LLC owned 2% of the partnership and they controlled it. So they stay in charge of daily management. Step 3, they transfer 60% of the limited partnership unit to a dynastic trust for their children. Because those LP units didn't have control or liquidity, a qualified appraisal applied a 30% discount, reducing the taxable value of the transfer from $12 million down to roughly $8.4 million. Step 4. They sold the remaining LP units to an intentional defective grantor trust, or IDGT, in exchange for a 9-year promissory note. This move froze the current value, meaning future growth and the assets now belong to the trust outside of their taxable estate. Step 5. They pay the trust income tax personally. That allowed the trust to grow without erosion, effectively making a tax-free gift every year. Step 6. They documented everything, meeting minutes, partnership agreements, capital accounts, bank statements, all clean and organized. In total, they used just 8.4 million of their combined 27.98 million exemption in 2025, but removed roughly 30 million in growth potential from their estate. If both passes 10 years later, they would save roughly 8 to 9 million in estate tax at 40% rate, while keeping complete management control the entire time. So, if you are wondering, could you do something similar? So let's walk through exactly how you would start this process. So let's move on to step 4, step-by-step implementation guide, which is going to be your roadmap. Let's slow it down a little bit here because this is where $1 million owner often get tripped up. I want you to think of this as a 7-step process, and each step builds on the one before it. Step 1. Identify your goals and estate size. Ask yourself, what assets do I want to transfer? Who should benefit? How much control do I want to keep? If your net worth is over 10 million, this conversation needs to happen now, ideally before your 2025 return or even finalized. Step 2. Form your entity. Work with an attorney or form an FLP or family LLC. The goal is to gather assets like real estate, business interests, or investment portfolios under one umbrella. Step 3. Appraise your assets. Hire a certified appraiser to determine fair market value. That appraisal supports your evaluation discounts and will protect you if they are ever audit the transfer. Step 4. Create a general partner entity for control. This is the you stay in charge step. So the GP, which is general partner, is often an LLC you own, holding 1 or 2% but runs everything. Step 5. Transfer limited partner units. Keep a portion of your LP units directly to trust or heirs. Use your lifetime exemption for this part, then sell the remaining LP units to an IDGT in exchange for a promissory note. So this converts a growing asset into a fixed value receivable, freezing its estate value. Step 6. Coordinate tax treatment. Because you, as a grantor, pay the income taxes, your trust compounds faster, and every dollar of tax you pay is one more dollar that stays in your family's ecosystem. Step 7. Maintain formality. This is where wealthy families win or lose audits. You want to keep records, minutes, separate accounts, and consistent documentation. If you treat it like a real business, the IRS will too. So, now that you understand how to set it up, let's talk about when to act and what happens if you wait too long. Let's move on to part 5, planning beyond 2026. So this is about timing and strategy. Here's where many high net worth families get caught off guard. The law says the exemption is now permanent, but we all know that in tax law, permanent is temporary until Congress needs revenue. Today, you have 15 million per person exemption starting in 2026, indexed annually, but we have seen this movie before, like in 2012, 18, and 25, and every time the conversation comes back to lowering the limit. So here how to plan smart beyond 2026. So use it while you have it. Transfer made during high exemption year are protected by anti-clawback regulations. Layer additional strategies. combine FLPs with GRATs or charitable lead trusts to move appreciating assets efficiently. Lock in valuations early. If you know a liquidity event is coming, like a sale, merger, or major appreciation, get your FLP formed and asset transfer fast. Review valuation every few years. Keep your appraisal current to maintain credibility. Now let's talk about the real secret behind why these partnerships are so powerful. It's not just the tax saving, it's the control. Let's move on to part 6, the control without ownership secret. So the beauty of the family limited partnership is simple. So you can transfer the economic value but still maintain managerial control. As the general partner or manager, you decide when distribution happens, how assets are invested, which property gets sold. Meanwhile, your children trust or holding companies hold limited partner units, meaning they benefit from the value but have no voting power. That separation from ownership and control is what makes the FLP structure so powerful. But this is important. It only works if you respect the structure. If you mix personal and partnership fund or ignore formalities, the IRS can unwind the plan under Section 2036 or 2701. So to wrap this up, let's tie everything together, what you should remember and what you should do next. So here's the big picture. So the big beautiful tax bill create a $15 million per person exemption starting 2026. So the highest we have ever had with no current expiration date. So that gives million-dollar earners and high net worth family a rare window to first consolidate and protect their assets. 2, move well out of their taxable estate using partnership and trust. 3, they can retain control over management decisions while letting the next generation benefit from the growth. This strategy isn't about giving up what you have built. It's about structuring it intentionally so your wealth grows inside your family rather than shrinking under estate taxes. So if you are a business owner, real estate investor, or a professional earning 7 figures or more, this is your time to act. Meet with your CPA, your estate attorney, and your valuation expert. Discuss how a family limited partnership or family LLC can anchor your wealth strategy, because legacy doesn't happen by accident, it happens by design. And under the new $15 million exemption, design is exactly what the wealthiest family are doing right now to secure their future. Thank you for watching. I'm Mia, and I look forward to see you at the next video update.